Ladies and gentlemen, something just happened that changes the entire game for the silver market in 2026. It is something most financial media will either ignore completely or radically misinterpret. The People's Bank of China, the PBOC, just pumped about 300 billion yuan into their financial system. That's roughly 43 billion US dollars in a single coordinated operation. And this isn't happening in a vacuum. It's part of a much larger 3.3 trillion yuan liquidity expansion happening in a very short amount of time. 3.3 trillion yuan. That is over 450 billion US dollars flooding into the Chinese economy through both government spending and central bank actions. Now, if you're sitting there thinking, okay, China did some monetary policy, why should I care? Why does this matter for silver, and how does it affect me as an investor? Stay with me, because what I am about to show you is how this massive liquidity injection is not just Chinese domestic policy. It's a structural catalyst that is already impacting global commodity markets, already affecting silver specifically, and already creating conditions that could drive prices significantly higher. Understanding this mechanism, understanding how Chinese money affects Western investors in precious metals, is critical for anyone trying to navigate what's happening right now in real time. Welcome to the Exposure Index. Before we go any further, a critical disclaimer: this is not financial advice. This is market education and macro analysis. I'm documenting observable monetary policy actions and their potential effects on commodity markets. I'm not telling you to buy or sell anything. I'm not recommending specific strategies. And I'm certainly not predicting the future with certainty. Please do your own research and consult qualified professionals before making any investment decisions. What I am going to do is walk you through exactly what China just did explain, why it matters for global markets, show you the specific ways Chinese liquidity affects silver prices, and connect this to broader trends like export restrictions and resource nationalism. This is about seeing the connections, about understanding the system, and about recognizing that what happens in Beijing doesn't stay in Beijing. Let's start with the facts, the verifiable data. In January 2026, the People's Bank of China used what they call the Medium-Term Lending Facility, or MLF, to inject 300 billion yuan into the financial system. But here's the important context that most media misses. This injection wasn't even enough to fully cover the old loans that were maturing at the same time. This signals that the PBOC is managing liquidity carefully. They aren't going all in with reckless abandon, but they are unquestionably adding liquidity. On top of that, on January 15th, the PBOC announced the first major easing move of 2026, a 1 trillion yuan rediscount facility that s about 143 billion US dollars, specifically targeted at private companies that need financing to maintain growth. And that larger number, the 3.3 trillion yuan figure, that comes from the massive increase in government bond issuance in the first quarter of 2026. We drew talking about an 80% increase compared to the previous year, an 80% jump. This capital is being rapidly directed to stimulate consumer demand, fund infrastructure projects, and pay for social subsidies, all to hit China's 5% economic growth target. This shift is what many analysts are calling Chinese QE, or quantitative easing. It involves allowing the PBOC to buy and sell government bonds directly, creating a new channel to print money that looks a lot like what the US Federal Reserve or the European Central Bank does. This is happening alongside cuts to interest rates and a reduction in the amount of cash banks are required to hold in reserve. So, why does any of this matter to you? Why should anyone outside of China care about their monetary policy? Because we live in a completely interconnected global financial system where money doesn't respect borders. When you have a massive monetary expansion in the world's second largest economy, it creates ripple effects, waves that affect asset prices everywhere. For American and other Western investors, China's actions are part of a systemic shift in global liquidity. This increase in the Chinese money supply, combined with expectations of interest rate cuts by the US Federal Reserve, is fueling what analysts call the debasement trade. This is what happens when investors seek protection against the loss of purchasing power in their currencies. When people realize that central banks everywhere are choosing inflation over deflation, expansion over contraction, they rotate their capital into real assets, into hard money, into commodities, into things that cannot be printed out of thin air. Let's talk about the dollar dynamics for a moment, because this is crucial. The United States faces what economists call fiscal dominance. We have persistent deficits and a continuous need to finance public debt. This puts constant pressure on the Federal Reserve's independence. With Jerome Powell's term as Fed chair ending in 2026, there are growing fears that new leadership might be pressured to keep interest rates low to make the national debt more manageable. That would weaken the dollar and drive even more interest toward precious metals and other hard assets. China's liquidity injection acts as another catalyst because all that extra yuan in the global system has to go somewhere. It flows into dollar-denominated assets or into global commodities, adding fuel to the fire. Then there's the trade uncertainty. Silver's recent inclusion on the U.S. critical minerals list, and the possibility of new tariffs on Chinese goods, has led to a preventive flow of metal into American warehouses. This is creating a squeeze on the available silver in London, driving up physical premiums and making the actual metal more expensive, regardless of what the paper futures price says. Now, let's connect all of this directly to silver. The silver market in January 2026 is experiencing a parabolic rise. It just hit $90 an ounce after a rally that saw prices climb 28% in just the first 2 weeks of the year. 28% in 2 weeks. That is not normal. That is explosive repricing driven by multiple forces all converging at the same time. The Chinese liquidity injection, supply shocks from export restrictions, and an insatiable industrial demand that cannot be delayed or substituted. Starting January 1st, 2026, China implemented new restrictions on refined silver exports. They now require government licenses that are only granted to very large companies. Since China controls between 60 and 70% of the world's refined silver supply, this caused an immediate global supply shock. This is the same playbook they used with rare earth metals. It's seen as resource weaponization, a move to ensure that silver stays inside China to supply their own technological and industrial needs. And remember, silver is entering its 6th consecutive year of a structural market deficit. Demand has been exceeding supply by somewhere between 120 to 230 million ounces per year. And you can't just flip a switch and produce more silver. Mine production is inelastic because most silver is a byproduct of mining for other metals, like copper, zinc, and lead. You can't just decide to produce more silver because the price went up. A new mine takes 5 to 10 years to go from discovery to production. Existing mines can't dramatically increase their output, so supply is tightly constrained no matter how high the price goes. The market indicators are screaming stress. The spot price hitting $90 an ounce represents a combination of strong technical momentum and a powerful fear of missing out. People are scrambling to get a position before it runs even higher. That OS, what happens when you have a fundamental supply and demand imbalance that gets supercharged by a massive flood of new money from the world's second largest economy. The pieces are all in place, and the market is reacting in real time. This isn't just a story about China. It's a story about global finance, resource scarcity, and the changing world order. And what we're seeing in the silver market is a direct consequence of these massive interconnected forces. The injection of hundreds of billions of dollars is not a theoretical event. It's a tidal wave of capital that is actively reshaping markets right before our eyes. The game has changed, and those who understand these connections will be best positioned to navigate the path ahead. Let's connect the dots on what's happening in the silver market, because the situation is getting extreme. In London, the LBMA vaults have seen their stocks drop by about 40% since just the start of 2024. Here in the US, COMEX inventories are down a staggering 70% since 2020. This is signaling a serious scarcity of physical metal available for delivery. It's creating a vulnerability to a massive short squeeze. Look at what's happening in Shanghai. There have been moments when the spot price in the West was showing $35 an ounce, but physical silver in Shanghai was trading above $80. That's not just a premium, that's a complete breakdown of arbitrage. It means local demand is so powerful, it's completely overwhelming the global pricing system. Meanwhile, the CME has jacked up margin requirements to 9% of the total contract value. This increases the cost for traders to hold their positions and forces some people out of the market. But here's the key. It doesn't create a single ounce of new physical silver. And the demand side is relentless. Industrial demand now makes up around 58% of all silver consumption. This isn't optional demand. It's driven by the global megatrends of electrification, artificial intelligence infrastructure, and solar panel production. The construction of massive data centers for AI, the use of silver in advanced chips, all of this creates demand that is deeply concerned with supply chain security. Manufacturers would rather stockpile metal at any price than risk shutting down their entire production line. This is what we call inelastic demand. These are buyers who don't care about the price because the cost of not having the metal is far greater than the cost of expensive metal. What we're seeing with silver's rally in 2026 is what analysts call reflexive. Rapid price increases attract trend-following traders. This forces those who are betting against silver to close their positions and cover their shorts, which in turn accelerates the price rise even further. This gets more media attention, which attracts more buyers, which forces even more short covering. The sheer speed of the move, taking only 6 days to jump from $80 to $90, tells you the market is in a state of extreme tension. It's like a stretched rubber band or a coiled spring. The entire system is under immense pressure. While hard asset investors are feeling optimistic, some analysts are warning about the risk of demand destruction now that we've hit $90. At this level, manufacturers might start seriously looking for substitutes or even reducing production. But this is a slow process. It takes a long time for those changes to show up in the official data. Then there's the gold to silver ratio. It fell to near 50-1 back in January 2026, a level where some strategists thought silver's outperformance against gold might end. But others argue that if this is a genuine supply crisis and not just a speculative bubble, historical ratios become less relevant than absolute physical scarcity. Now, let me show you how a massive liquidity injection from China is directly fueling this entire move. When China pumps hundreds of billions into its economy, several things happen to commodity markets all at once. First, domestic Chinese demand for industrial materials skyrockets. More liquidity means more economic activity, which means more manufacturing, which means more silver is needed for electronics, solar panels, and electric vehicles. China is already the world's #1 industrial silver consumer. More stimulus means they need even more. Second, Chinese companies and citizens start looking for ways to protect their wealth. When the money supply expands that quickly and the currency is at risk of weakening, capital naturally flows into hard assets, precious metals, commodities, things that hold their value when paper money doesn't. Third, global commodity prices react to these powerful signals from China. When the world's largest consumer economy starts stimulating, all commodity markets anticipate higher demand and begin to reprice everything higher. Silver reacts particularly violently because its market is much smaller, thinner, and more sensitive than gold or oil. And fourth, and this is absolutely crucial, China is combining this domestic stimulus with export restrictions. This creates the perfect storm. They are increasing their own internal demand through monetary expansion while simultaneously decreasing the external supply through export controls. It's a pincer movement. It's strategic resource management. You could even call it the weaponization of commodity flows. For buyers in the West, American manufacturers, European industrial users, this creates a crisis. They face higher prices driven by monetary inflation combined with restricted access to the metal itself. They are forced to compete for a shrinking pool of available supply, while China's domestic demand absorbs more and more of the total global production. Now, let's add the geopolitical dimension. The trend of deglobalization is a defining feature of 2026. Countries are prioritizing national sovereignty and supply chain resilience over pure efficiency. This creates structural inflation. The global system of shared metal inventories is fragmenting into regional silos. This means you can have localized scarcity in one part of the world, even if the global numbers look adequate on paper. China's liquidity injection serves two purposes. It inflates asset prices within its own sphere of influence, and it ensures its strategic industries have the capital to dominate key markets like electric vehicles and green energy. For American investors, this means we are importing inflation not just through finished goods, but through the rising cost of raw materials. Manufacturers have to either absorb these costs, crushing their profit margins, or pass them on to you, the consumer. The trade to get out of fiat currency and into hard assets is intensifying as more people recognize that the purchasing power of their money is eroding. Let me give you a framework for what this means going forward. $90 silver represents an inflection point where the market's momentum is clashing with the limits of industrial demand. Some analysts are now projecting $100 as a conservative target for 2026. The reasoning goes like this. If gold reaches $5,000 an ounce, a scenario supported by central bank de-dollarization and continued money printing, and the gold to silver ratio reverts to a more historical average of, say, 40-1, then silver naturally trades at $125. It's just simple math. 5,000 divided by 40 is 125. The long-term outlook, looking out to 2035, gets even more aggressive. As easily accessible silver deposits are exhausted as primary mine production peaks and as recycling, which only covers about 30% of demand, fails to bridge the growing gap, silver could be repriced not as a precious metal, but as a rare and indispensable technology metal. Some models are suggesting prices over $300 an ounce by 2035, as the global economy's transition to full electrification becomes non-negotiable. But let's stay grounded in the present. Let's focus on what we can observe and verify right now. China's 300 billion yuan injection is a confirmed fact. The broader 3.3 trillion yuan fiscal expansion is documented reality. Silver hitting $90 is observable price action. The massive premiums in Shanghai are verified by multiple data sources. The Chinese export restrictions are official government policy. These aren't projections or theories. These are facts on the ground. The real question is how you interpret them and how you position yourself given this information. I can't give you financial advice, but what I can say is this. The convergence of Chinese monetary policy export restrictions, A structural supply deficit for the sixth straight year in elastic industrial demand and collapsing Western vault inventories creates a condition that historically leads to sustained higher prices. The sheer speed of this rally suggests the market is repricing based on a fundamental recognition of scarcity, not just speculation. But be warned, the volatility will be brutal. Pullbacks of 10 or 15% will be designed to shake you out and test your conviction. During those corrections, the physical signals will matter more than the paper price. If premiums in Shanghai stay elevated while the spot price dips, or if delivery times remain long, those are confirmations that the physical tightness is real, regardless of what the derivative markets are doing. Here's a framework of what to watch. First, Chinese monetary policy. Do they keep stimulating or do they tighten? Second, export restrictions. Does China actually enforce them or do people find workarounds? Third, industrial demand. Do we see substitution or production cuts? Fourth, inventory trends. Do COMEX and LBMA vaults continue to drain? Fifth, the premium structure. Does Shanghai maintain its massive premium? And sixth, the price action. Does silver hold $90 as support? These 6 factors will give you real-time feedback on whether this thesis is playing out. Of course, there's a counter-argument. The bear case is that $90 silver is simply too high, that demand will be destroyed, substitution will accelerate, and the speculative bubble will pop, sending prices crashing back down. It's a valid risk to consider, but when you piece together all the evidence, the empty vaults, the inelastic demand, and most importantly, China's strategic combination of monetary stimulus and export controls, it paints a compelling picture of a market under unprecedented strain. The facts are on the table. All right, let's break down the silver market. Everyone's talking about $90 silver, but what could actually stop this rally in its tracks? I see 6 key risks, and we need to look at them honestly. First, demand destruction. It's a real possibility. At these prices, manufacturers could finally find cheaper substitutes or just cut back on production. We might not see it in the data yet, but it's a threat. Second, recycling could ramp up and fast. High prices create a massive incentive to pull silver out of old electronics, solar panels, and industrial waste. If recycling accelerates dramatically, it could definitely ease the supply crunch. Third, what if China's big economic stimulus plan just fails? Their 5% growth target is ambitious. If all that money they're printing doesn't translate into real economic activity, then industrial silver demand from the world's biggest consumer is going to weaken. Fourth, geopolitical tensions could cool down. Imagine if trade negotiations actually succeed, or those export restrictions from China get relaxed or just bypassed. If silver starts flowing freely again, how come that supply shock that's been driving prices just evaporates? Fifth is speculative positioning. What if everyone who wants to buy silver has already bought it? If the market is flooded with long positions and there's no new money coming in, it becomes incredibly vulnerable to a sharp correction where selling just triggers more selling. And sixth, central bank policy. What if the Fed doesn't cut interest rates like everyone expects? If they hold steady or even tighten and the US dollar gets stronger, that creates major headwinds for all commodities, including silver. These risks are absolutely real. These scenarios are possible. Markets never move in a straight line, and nothing is guaranteed. But when you really weigh the evidence, when you compare the structural forces to these temporary factors, the case for sustained, higher silver prices still looks stronger than the case for a collapse back to where we were. Let's be clear. China's liquidity injection isn't just a temporary emergency fix. It's a fundamental policy shift, a strategic decision. They know their economy needs this monetary support to hit its growth targets. And those export restrictions, that's not a simple negotiating tactic. It's resource nationalism. It's China recognizing that silver is a strategic material for their entire technological future. The structural deficits we're seeing aren't just a temporary supply chain hiccup. It's simple math. When you consume more than you produce, year after year you run out. The inventory declines aren't normal market cycles. They're a systematic draining of available metal, suggesting that the claims on silver far exceed what's physically there. When you combine those structural realities with a massive flood of cash from the world's second largest economy, you get the perfect conditions for real assets to outperform paper money. You get a situation that favors commodities over currencies, and specifically, it favors silver over the dollar, the yuan, or the euro. Now, let me address something that holds a lot of people back, even when they get the big picture. It's that feeling that you're too late, that you missed the boat, that buying at $90 is just buying the top. Look, I can't tell you if $90 is cheap or expensive. I can't predict if we'll see 70 or 100 next. But what I can tell you is this. If the structural case is correct, if we are in a genuine supply crisis combined with global monetary debasement, and if silver is truly transitioning into a critical tech metal with a capped supply, then today's prices might look incredibly cheap a few years from now. Markets that reprice based on true scarcity don't care about old price charts or resistance levels. They discover a new balance by pushing prices up until demand finally breaks or new supply actually shows up. We don't know where that new balance is. It could be 100, 150, or even higher. Or maybe we do pull back from 90. The point is, the underlying structure of the market has changed. The old rules about where silver should trade might not apply anymore, not when China is weaponizing exports while printing hundreds of billions of dollars. So let's bring this all together into a clear framework. China just pumped $43 billion into their system. This is just one piece of a much larger, nearly $500 billion expansion happening in a very short amount of time. This is their policy. This is their strategic choice. For global investors, this creates conditions that have historically been fantastic for real assets. Silver benefits in multiple ways. The stimulus boosts Chinese industrial demand. Chinese citizens, seeing their currency supply expand, look for a safe place to store their wealth. And the global commodity markets react to signals from their largest consumer. You have export restrictions creating a supply shock while monetary expansion drives up demand. It is the perfect storm. The current price is an inflection point. It could hold, it could break higher, or it could correct before the next leg up. But the deep structural forces suggest we are in a new pricing regime, not just a temporary spike. The framework I've given you provides real-time signals to watch. Keep an eye on Chinese policy. Do they keep printing? Watch the export enforcement. Track the industrial demand data and inventory trends. Look at the premiums for physical metal. And of course, watch the price action itself. These 6 factors will tell you whether the thesis is holding up or breaking down. The debasement trade is on. Central banks everywhere are choosing expansion and inflation over contraction and deflation. This drives capital toward assets that can't be printed out of thin air. Silver sits at the perfect intersection. It's both a hedge against inflation and a vital industrial component. It benefits from both economic fear and economic growth. That dual demand is what makes it so potentially explosive when both engines are firing at once. What we're witnessing is the financialization of scarcity. It's where a flood of created capital chases a finite amount of real resources. It's where the gap between paper promises and physical reality becomes too wide to ignore. Subscribe to this channel because we are going to keep tracking Chinese monetary policy, monitoring the silver market structure, and documenting this fascinating interplay between Eastern liquidity and Western commodity prices. Like this video, if this kind of deep structural analysis helps you see the markets more clearly than just looking at a price chart, and comment with your own perspective. Do you think this Chinese stimulus is the ultimate bullish catalyst for silver? Or do you think demand destruction at $90 is where the party ends? That debate is crucial. The alarm is sounding. China just injected $43 billion. Silver just got a powerful new tailwind. The only question is whether you recognize the signal now or wait for the confirmation that only comes after the big move has already happened. Stay analytical, stay informed, and remember that understanding global liquidity is the key to navigating these markets. I'll see you in the next analysis.